How exactly do you choose an ETF? In today's video, we're going to be breaking down two foundational ETFs that are really the basis when it comes to any investment portfolio. We're talking about the VOO, which is the Vanguard S&P 500, and also the VTI, which is the Vanguard Total Index. So we are talking about everything. Now, when it comes to both of these ETFs, you are looking at these as being the foundation. This is going to be the basis. When we start breaking this up systematically in a 3 ETF portfolio, this is roughly 30 to 40% of your portfolio, which is going to be for an extended amount of time, the real foundation. We start looking at some of our growth ETFs. We also start looking at some of our dividend ETFs to really round out that 3 ETF portfolio. So let's go ahead. We're going to break down the VOO. Then we'll get into the VTI. And then I want to do a side-by-side comparison of both of these. So let's go ahead and break this down. Now, the first one we look at is the VOO. Now, personally, this is one that I do hold in that 3 ETF portfolio. And actually, I have one that is built for myself. I also do have a 3 ETF portfolio that are built for my kids that are different ETF portfolios. But looking at this, one of the biggest things you'll notice right off the bat is it has a very, very low expense ratio. That is why so many people do really focus on this ETF. A 0.03 expense ratio is a really great expense ratio when it comes to an ETF overall. And Vanguard has some of the absolute lowest ones. Now, you notice also that there is a 1.19 30-day SEC yield. So when you think of dividends, when you think about the ability to produce income, this is not going to be the ETF that we're focusing on. This is not going to bring in a lot of income. You're not going to see a lot of dividends. The reason being, a lot of the larger tech companies that we have will really opt to reinvest all of their really earnings that they have from the company. We see a ton of research and development, even with the focus on artificial intelligence. Now, you notice so far this year, we are looking at a 4% return. So with a lot of changes in January with the Fed announcements, and of course, the changing of the president in the United States, we see a 4%. So overall, doing pretty well with the year-to-date return. I'm happy that it's not negative and we're not seeing, the market really doing a big pullback. Now, since inception, you'll see this has been 15 years since this ETF has been out, meaning it has a huge amount of money in here, which we'll look at in just a minute. Because again, when you think of the foundation, there's no better place to invest when it comes to really breaking this down. The price, of course, at 560. Then we get into the performance. This is where it gets interesting. So looking at the last 2 years of the performance with the VOO, we have seen over 20% double-digit growth, even thinking of the last year. So this is, of course, through 131. So this is through the end of January. We're looking at a 1 year of 26.29%. That is incredible to see the performance. And of course, that lifts up all of the other years with 2 very strong years that we've seen. Looking at our 3-year, 11.86. 5-year gets into 15.11. Guys, we have seen a 15% return in the VOO in the last 5 years. Now, my portfolio specifically, I've been investing 4 of those 5 years. And the very first year that we were invested was actually a pretty strong down year. So happy to see where my performance is. And then, of course, the 10-year comes in at 13.71. So since inception, you are talking 14 years. This has been here. We're at 14% going on 15 years that we have had this. We're almost at 15%. Again, thinking of growth, thinking of a foundational ETF that is going to hold and really track that S&P 500 index. And this is the one that you want to invest in. You could do the different variations. There's a couple different ETFs, essentially from different companies that track the exact same index. I know the SPY and a few other ones that do track the S&P 500 index. But Vanguard has also announced that some of the fees that they have for ETFs and some of their funds are going to be reduced. We don't know exactly what that list looks like, what they're going to break down, but you can see the fund can't really get any cheaper when you're looking at a 0.03% expense ratio. When you look at similar funds, 0.77. Now, Vanguard, again, has focused on really making these funds affordable for everyone to invest in. And of course, my favorite personal investor, Warren Buffett, really talks about the VOO and everybody should own it, which I agree with 100%. everybody should own it, but at what percentage depends on how old you are and when you're getting into the investment game. Now, S&P 500, it is the one for one. It is a straight beta because it does track the index in its entirety. Again, market price $560, so a little bit on the more expensive side, but that's okay. Consistent contributions going in here. Then we look at the historical price. You can see there has been a very solid growth in that last 10 years. Looking down here at 193 all the way up to the 560 we're seeing now, we have seen a tremendous amount of growth. Now, the portfolio composition, this is the important part. This is something that you have to look. So they are going and posing this as a large blend. Now, this has been a question that a lot of people have. A lot of people are saying with looking at this ETF that it is more of a large growth than a large blend, but Vanguard is still dropping it into the large blend. And they're saying it's moving a little bit more into the growth category because of the enormous size we're seeing from those mega cap companies and the size that they are. Now, earnings growth rate, 19.8%, very strong there. And look, fund total assets, $1.4 trillion. Let's break down the companies that are held within here, which makes a big difference. So, of course, this is weighted. So it is the weighted average based on the size of the companies. Something very important to remember. It's not value. It is weighted, it is market cap weighted by the size of the company, meaning companies like right here, information technology, this is going to make up single-handedly the largest chunk of this. When we think of our tech companies and you start breaking this down, you're looking at your Apple, you're looking at Meta, you're looking at Alphabet, you're looking at NVIDIA. Any of those really mega cap large companies are going to be included in this information technology sector. Then, of course, you look at financials. When you look at financial institutions, really the backbone of America, the banking infrastructure that we have, the mortgages, lending, credit cards, everything else really falls into this financial sector, which again makes up 13.6%. Now, the interesting thing is when you look at the weight and when you look at the companies themselves, this is where a lot of people have issue with the VOO that I want to address, is when you start looking at these larger companies and looking at our holdings, when you start looking again at, let's say, these top 10 companies that are in here, the weight of these companies will shift the value of this ETF in its entirety. If Apple has a bad day, the S&P 500 falls. If Amazon, Facebook, Tesla have a bad day, it is doing the exact same thing because they are so heavily weighted. Even looking at Apple itself, they are 7.59% of this fund. It is a monster when it comes to being able to move this fund. And again, thinking of these, this makes up, I believe it was 35 to 37% of the entire fund itself, or the entire ETF itself is made up of just the top 10 holdings that we have within here, making it a really, really large fund overall when it comes to getting a little bit more balance and having a little bit more risk allocation. That is the reason why the VOO does come in as one of my absolute top. And again, one that I invest in is when you think of diversification, the Vanguard S&P 500 holds 500 top companies within the United States. And when you start looking at those 500 companies, we've seen consolidation, we've seen buyouts, we've seen acquisitions. And also within those, that is about 80% of the entire stock market. So when you start looking bigger picture, getting out into the rest of the stock market, or essentially that last 20% that we see out there, then we look at the next ETF, which is the VTI. So looking at the Vanguard Total Stock Market ETF, this again has the exact same expense ratio, the 0.03 we see. Same SEC yield, 1.17, which I think that's right on par with where it was. Now, the thing with this is when you start looking at that VOO or that S&P 500, you're in the 500 largest companies that they do have. This one is a large blend. Again, very similar returns. We'll do the side-by-side comparison in just a minute. But when we start looking at the performance, again, the performance of this is much lower. Now, when we think about this and think about it mathematically where this is at, this performance goes back another 9 years. So we're dealing with, within this one, the entire housing market bubble. And of course, the inception of this was right after Y2K and everything else in 2000. So the following year, this VTI came into inception. So of course, this one is going to be a little bit lower. when we start looking at our 1 year, the 3 year, the 5 year, even the 10 year, very similar performance than what we've seen with that S&P 500. But overall, remember, 20% of this ETF gives you exposure to the mid cap and the small cap that are in the United States. This is everything that is publicly traded within the market itself. Now, looking at this, the interesting part of this is the holdings. When we start getting down here to the actual compensation, I can't say that word tonight. Looking at the number of stocks, we had 503 with the VOO. We are at 3,609 within the VTI. So it does have a different benchmark. It is tracking a different index. But overall, you are thinking of going from the diversification of holding 500 different companies to holding 3,600 different companies, which is kind of incredible when you look. So one kind of gives you a snapshot of those largest companies within the United States. The second one gives you the snapshot of the entire financial really picture or publicly traded companies in the United States overall. But you'll notice that when we start looking at the cap, they are very similar. You can see technology in here, 35%. They are very, very similar makeup because remember, again, those technology companies, when you start looking at Alphabet, Microsoft, NVIDIA, Amazon, they are so large that they still make up a majority of this pie. And I believe Apple was just over 7%. So you're giving up about 1% here and there. Again, that is going to mathematically break down to the 20% that is going to make up your mid cap and your small cap when it comes to this index in itself. And of course, looking at this, it is the entire stock market. Like we said, you are invested into everything. Now, traditionally or historically, most of the time when inflation started coming down, when we started seeing rates coming down, the small caps and the mid caps would perform exceptionally well and actually outperform the large caps. However, in the last 10 years, we have seen that kind of flip. This is really driven by two big factors. Number one, the artificial intelligence. The companies that are investing into artificial intelligence have been really killing it and crushing it over the last couple of years. And the second one, of course, in my opinion, is quantum computing. When you start looking at the tech sector and the amount of growth that they're going to have coming in the future, seems like it's going to make a really big difference for all of these larger companies. And most of the companies, even though they are large, they are diversified into so many different products and services and areas and countries. That is the reason when it comes to me personally, I do not invest into anything international. The reason being, when you start looking at these larger companies, they are already international companies. They are operating in almost every single country within the world, which makes them kind of a global company. Even though they're based in the United States, like Apple, they are selling phones in China. They are selling phones all over the world. Same with Google, same with, the rise of the internet itself, giving us access to everything across the world. So now let's go ahead and let's take a look at a side-by-side comparison. Looking at the VTI and the VOO, very similar again when you look at the price. The VOO, quite a bit higher price right there. But when you look at the trade volume, they're almost triple the trade volume. Again, follows the S&P 500. This one follows the CRISPR US total market, which again, holdings is the big difference where you're at 35.61 right here. We're at 504 with the VOO. So if you're an individual that is looking for diversification in the market, the VTI is going to be a choice. And again, I want to break it down and show you, because if you are looking for just straight up diversification, even though the VOO does offer it in a large scale, the VTI, of course, is going to have a huge and a lot higher diversification rate because you're holding those mid cap and those small caps in there. Now, when we start looking, these are pretty much mirroring each other, as you can see across the board. Performance is almost the same. You can see they're almost the same, except the VOO is about a 0.3, 0.4 higher than we're seeing with the VTI. So again, little change when it comes to those small caps and mid caps, when it comes in terms of performance, until we start looking at where the VOO is running away. Even looking at the 5 year, you can see it starts kind of breaking it out. And again, this is really driven by the drive from artificial intelligence over the last couple of years. Even looking, you can see VTI outperforming right here, 3.99. Again, the reason for this is those small caps that are performing exceptionally well. When you start going up to 3 months, you can see 3 months, the VOO is outperforming. Year to date, we still do have the VTI that is performing. And then, of course, a little bit more on the year with the VOO, and the exact same with 3 years and 5 years. And if this trend continues, the VOO could outperform the VTI this year as well. Like I said, with the top 10 holdings, you'll see this again is a perfect mirror because it is market weighted cap, but the difference in the holdings where, you know, the VOO is holding Apple in 1% higher than what we're seeing over here with the VTI. All of those percentages rolling right down into those mid caps and those small caps themselves and really breaking it down. So as we look down here, again, looking at the percentages, a little bit more focus on that electronic technology, a little bit more on technological services or technology services, and of course, a little less in the financial sector, because over here, we're including all of those smaller banks that we have that do not make it into that S&P 500 fund. Very similar price to earning ratio. And I actually like this one a lot better. And interesting enough, because when you look at the VTI, price to earnings, when it starts getting too high, like a lot of the tech companies, the price doesn't make sense. That is where a lot of people, you know, say that right now, looking at those 10 largest companies of the S&P 500, that they are very, very overvalued, and they're waiting to see some sort of tech bubble, some sort of market correction because of the price to earnings ratio, which looking at the VTI is significantly higher than what we see in that VOO. So overall, guys, my thought within here is looking at these and the performance of both of them over the last 10 years, the VOO has done a lot better than we've seen with the VTI. And honestly, looking at the focus of just investing into those small and mid caps, which make up 20% of the market, still a relatively small part of the market. But overall, I invest personally, and I do advise people to invest in that VOO. Now, I am not a financial advisor by any means, but looking at the portfolio and the growth that I'm seeing out of VOO, and I feel like the technology sector is really going to be driving for the next couple of years, making it very worth it going in. And again, fundamental part of the portfolio, meaning it's about 30% of your entire portfolio. And I believe in mine specifically, this does make up 30% of my portfolio in the entirety. It is a very good staple to hold for an extended amount of time. So, all right, guys, so that is going to do it for today's video. If you like the content, definitely consider subscribing to the channel, and I'll catch you in the next video.